Okay, so we'll start. So you can just open this site, moneycontrol.com. Okay, I'll just send you the link where you have to go. Okay, have you got this? Have you gone through this place? Have you opened this? I'll just share the link where you have to exactly go. Okay, yeah, I'm just going to. So just open this link. Okay, so you'll go straight away there. Fine. So some students are still missing the 3, 4, 5, 6, and so anyway, I've recorded this, so no problems. Fine. So today we are going to start with a topic called mutual funds. Okay, this is part of your financial services course of merchant banking. And have you ever studied mutual funds? आपने पढ़ा है? आप लोगों ने formally class में? Okay. So I am going to teach you straight away from the practical point of view. Okay. Mutual funds are basically schemes which invest money. So if I just share the slide with you, I'll share the slide also. Good morning, good morning, good morning, good morning. आप सारे सर लेट आते हो? Good morning, good morning. So please attend. These are two very, very important classes. You'll learn a lot. Okay. I hope I just covered this topic earlier with my last week, maybe last to last week, and students found it was quite interesting. Okay. So what we are doing, we are going to understand. I'm going to share the slide, but we are going to do most of the practical. So you need an Excel sheet. Do you have your laptops with you? Okay. So if you don't have, next time you just bring it. If some of you don't have, fine. So how many are not having a laptop? आपके पास नहीं है, आपके पास है, सबके पास है, सिर्फ आपके पास नहीं है, कोई बात नहीं. Just you can just share, okay, and then you do it. You have to do the exercise also later on. Of course, today will be all explanation. So mutual funds, we are going to start the mutual funds. Basically, what are mutual funds? Basically, uh, so what is a mutual fund? So first we understand the definition, okay. So it is a trust that pools the savings of several investors. So it's basically a trust. They collect the money on trust and it is pooled, okay, into a scheme, okay, and the investors, they give the money to the mutual fund manager or the asset management company, and then it is pools invest these into different kinds of securities like shares, debentures, money market instruments, or combination of both of all these. Okay, so they invest into shares, bonds, into debentures, into money market instruments. Okay, I will understand each of them a little bit in detail, and sometimes they combine them also. So the whatever they earn out of this, that is that is generated. The income thus generated and the capital appreciation is distributed among unit holders in the proportion to the number of units held by them. So whatever they earn in terms of capital appreciation, because the market goes up, okay, then if they have invested in shares, the mutual funds value will also go up. Okay, so then they share it among with the unit holders. Either, I mean, it brings the capital appreciation to you, or they even declare sometime dividends if you subscribe to a dividend scheme. So mutual funds are of two types: dividend and growth. If you put your money in a dividend scheme, you will get annual dividend. If you don't subscribe to dividend, you go to growth fund where they'll not give dividends, but you can always sell them, redeem them, and whenever you need money. But it is always advisable to go for growth funds rather than dividend funds because of the current taxation system, because dividend are subject to tax, okay, and there is a TDS which is deducted whenever the dividend is paid to you. Whereas when you invest in mutual funds and there's a growth, then you have a certain exemptions given to you. So we'll talk about them, okay. So it is much uh, tax benefit you get if you put them into growth. So it's always advisable now to go for growth funds, unless there is a compulsion that you want to have a dividend and you can, pay tax, or you can even save tax by filing your return and claim reduction, refund. So it's like this, if you look at this graph, investors pool their money, okay, pool their money with the fund manager and invest in securities, generate returns, pass back to the investor. So that's the cycle of a mutual fund. Okay. Now, what are the benefits of the mutual funds? Number one, I mean, if you invest in one stock or a couple of stocks, like when you invest in mutual funds, your money is well diversified. Money is, spread across various shares or bonds or debentures or money market instruments. So you get the benefit of diversification with a very small amount. You can give 5,000 rupees per month. Your money is diversified. Even your 5,000 is spread across various, shares and debentures. But when you do it yourself, then you can't buy anything for 5,000. If you want to buy Reliance, it's about 2,800 or 700 today. So maximum you can buy 2 shares of Reliance. Okay. But when you invest, in mutual funds, your money is spread across various shares. Even you may own zero point 0.1 share of Reliance in that amount, okay, which you can't do in the cash market when you buy it directly. So with a very small amount of money, you can diversify this thing, and they are managed by the professional managers. Okay, so they know where to buy, which stocks to buy, okay, when to exit. But when you do it yourself, uh, again, you should have time. If you're working or if you're working professional, you can't put time so much time into your portfolio. So it is always better to leave it in the hands of the fund manager who is an expert. So though of course you're going to pay some kind of a commission or a fee for doing that, but it's not a big amount, so you can always give it to a fund manager. It may roughly about to be 1% if you're investing into equity oriented kind of a scheme. So 1% per annum goes. If you invest to a distributor, the amount can go up to 2%. Okay, I will talk about that more in detail. So there's an example here which I mean, you can just go through, how your money gets diversified. So I'm just skipping this. Now, what's the structure, of the mutual fund? So there is a sponsor who thinks about, opening a mutual fund house. So, they appoint trustees. Then a asset management company is formed. That company would be registered to take money from you. Okay. Like, for example, Reliance Group, like Ambani's, they may think about, starting a mutual fund. So they'll be sponsors. So they will appoint certain people as trustees so that they can form an asset management company. So we have a Reliance mutual fund now coming out of the Reliance, group. So the AMC is basically the Reliance company, Reliance Mutual Fund Company, or HDFC Mutual Fund Company, or like this you have so many mutual, BlackRock, fund house or whatever. They have been acquired by Nippon. Yeah. Now it is all in Nippon. So it's a Japanese this thing. So then there will be depository, there will be registrar, there will be transfer agent, and the auditor and the schemes. So this is the structure. So they, all the if they buy shares, they will be in the demat account. So they will be in the schemes demat account will be there. Okay. So there are two depositories in India, the National Deposit. Yeah. So these are the two depositories who will keep your shares, but it will be in the name of the mutual fund scheme. Okay. So then there is a registrar. Whenever there is any issue with regard to, you have not received your dividend or you have received your units, so you can always write to the registrar if there is any issue regarding your investment. Then a transfer agent, auditor, and the scheme. So these are all the people who combine and become I mean, they invest into the schemes and they are monitored, and all this is monitored by SEBI basically, which is the board. The typical mutual fund house, they are regulated by SEBI. Okay. So for example, just to give an example, HDFC Bank, who sponsored and they formed the asset management company, okay, which is called HDFC Mutual Fund. Okay, fine. So this is how these schemes have AMCs has come into being. Okay, so now we have so many asset management companies. There are about 20, 25 asset management companies or more. I don't have a track of them. So we have like, Birla Sun Life Management, Reliance Mutual Fund, ICICI Prudential. So there are many mutual fund asset management companies who are taking your money and investing into all these this thing. And now, the main part, there are about, 5 categories of mutual fund. Earlier, maybe about 10 years back, these categories were not defined by SEBI. Nobody had defined them, so SEBI wanted to bring them, in a very streamlined manner. So they classified that there'll be only five schemes. One will be called equity, where your majority of money will go to equity, or almost all the money will go to, and sit in equity. So the schemes which are announced will put your money into equity schemes only. Then debt schemes, where your money will go into bonds, whereby you earn a fixed income, kind of a return on these schemes. Okay. Then there are hybrid schemes, where the money will be put both in debt as well as equity. Okay. So somebody wants to, want to have an exposure in both, so he may choose a hybrid scheme. Then solution oriented. For example, you have a child education. I mean, this thing you want to save for your child, or you want to save for your retirement. So these are some solution oriented pension funds. So all these will have schemes which are oriented towards these solutions. Then other schemes, like for example, you want to invest in a Microsoft or Apple. So these are the schemes where the money will be put into foreign securities, okay, or it will be a fund of funds basically, okay, like a fund invest into different kinds of funds, fine, and ETFs, exchange traded funds. So we'll talk about them, okay. So now that as I think we have already discussed, the top 100 companies in India in terms of market cap, they are classified as large caps, okay. Then from 101st to 250th companies in terms of market cap, they are classified as mid caps, okay, and 250 and beyond, they are classified as small caps, okay. You have seen that list, isn't it? I've shared with you. No. So there is a I'll just try to just locate if I have got. So every I think 6 months or 3 months, these there is a uh, average market capitalization. So these there is a list which comes out every month, and you can always download them. Okay. So it talks about the company average capitalization of listed companies during the 6 months ended 30th June 2020. This is not the latest one, so you can always download the latest one if you want, but doesn't make any difference here. So the top company in India which has the highest market cap is Reliance Industries. Okay. So if you look at Reliance market cap was at the time it was 13 lakhs 55,000. So there is a market cap both at the National Stock Exchange as well as at Bombay Stock Exchange. So both are given, and then there is an average of all the stock exchanges. Okay. So if you want to see that, Reliance was the top company in India who has the highest market cap. And market cap, you all know, it's basically the share price multiplied by the total number of shares the company has in the market. Okay. हाँ जी. Yeah. हाँ अभी तो ज़्यादा है काफी 17 lakhs. Okay, we can just go. Then we have the TCS, HDFC Bank, Hindustan Liver in order. Okay. The second highest company in terms of market cap is TCS, and the third is HDFC Bank. Okay. Then it goes up to 100. Okay. After that, it starts with 101 with a green color. So it stops somewhere at 37,000 crores as market cap. So all the companies which are around 37 or 40,000 crores, they are all called large caps. Then the companies below them, which starts from say 36,000 onwards, it's cut off actually. Without looking at the market cap, it is only the top 100 companies become large cap, and then subsequently till 250. If you look at the biggest mid caps, PI Industries, Jindal Steel, Godrej Property. So these are all mid cap stocks. Then going down further. So then it starts somewhere here. Like companies. These are the companies which are below 11,000 market cap. So these are all small caps, like Hindustan Copper Limited. They have the head office in Kolkata. I happened to go there and audit their accounts. That was way back in 1985 or 90 or 86 around. I was there in Kolkata and auditing for this account. So anyway, so these are the mutual fund this thing. So you can just you can, or anybody, you can just download average market capitalization, okay, from Google, and just share it in the group. Okay, then you can just go through as and you want. Fine. So now with this knowledge, we will just go to a site, okay, which I have asked to. You can just go to the WhatsApp group. There's a link which I have given, and you can open this site, okay. So we'll be working mainly on this site, and we have to have some, you can open a blank Excel sheet also, so that we can download some data and understand. So if you look at, there are five heads: equity, hybrid, debt, solution oriented, others. As I told you, there are five main categorization of all mutual funds, and within equity, there are 13. I'll just take your question. There are 13 schemes, subcategories. Okay. Yeah. What's your question? So yeah, that's a good question. There are five categories. Within five categories, there are subcategories. Like for equity, there are 13. Within each category, you can either go for a growth scheme or a dividend scheme. Fine. So you will come to know all this. Okay. We'll just go to one and you'll understand. Okay. Fine. So this is equity. Okay. So equity, if you look at equity, so we have, like large cap, for example, large cap. Then we have large and mid cap. Then we have ELSS, small cap, contra fund, focused fund, value fund, thematic, flexi cap, mid cap, and ETFs. So there are 13 subcategories of various schemes under the equity itself. Okay. So just to talk about large cap, which means this will have mainly all top 100 companies. Here when you choose a large cap scheme and you want to invest in that, that means, the fund manager has a mandate to invest majorly into all top 100 companies in India, all the blue chips or all the big companies of India. Okay. Now, if you invest in a large cap, you always feel that you are secure. Okay. They are very big companies having a market cap of above 37,000 crores currently. So you want that your money should be parked only in top 100 companies of India. So then you choose a large cap. Okay. Comparatively, it is a safer bet. But the large caps, they don't grow so much at a good pace. Fine. But they are steady returns. Fine. For example, if you take a mid cap for a long time horizon, the mid cap, scheme will give you a higher return than the large cap. Similarly, a small cap will give you much higher, but the risk keeps on increasing. Okay. So then there is some scheme called, large and mid cap. Here, their money will be put only in large and mid caps. So here you want to take a little more risk, okay, but you want to just take some exposure on the mid caps also, so you can invest in mid cap. Then a small cap, which is the highest risky because they're investing into small companies which are having a market cap of just less than 10,000 crores or 10,000 crores. Then there is a multi cap. Here you are giving, free hand to the fund manager that he can invest into any good company in India out of all 10,000 companies. If suppose there are 10,000, all 10,000 companies in India, he can put your money in a multi-cap. Then we talk about, thematic or sectoral funds. Here, the money will go only to a sector. Like suppose if you think the pharma sector is going to do well, then he is going to put your money only into pharma companies of India, like Cipla, Sun Pharma, Lupin, all those pharma companies, which he thinks that, they are going to grow. So he is going to put the money into those sectors, like banks, the banking sector. So if you are very bullish on, financial services and you want to invest in banks only, then you can buy a fund which represents that sector. But it is always riskier to invest into sectoral funds because if something happens to a particular sector, then the whole sector is going to go down. Like for example, pharma. In the last 1 year, it has not performed. If you see, the pharma sector has not done very well in the last 1 year. But before the last year, after the COVID time, it was doing very well. That time, just I had invested into pharma sector, and my money doubled in 2 years' time. Fine. But now it has remained stagnant. I could have, taken out my money and moved to some other fund if I want, but I still invested because there's always a cyclical movements up and down. So pharma will do well again. So if you are a long-term investor, then you should not be bothered about such things because pharma companies are good. Okay. But again, it's a risky sector. All other stocks are going, pharma is just lagging behind. If you have put all your money in pharma, it will not grow. You'll find all others money is growing and you're just there. So it will give you a kind of a headache, or you will feel that it is not growing and everything. The stock market has now reached to all-time high level. Yesterday the Nifty touched all-time high level, and then we have like ELSS. ELSS means equity linked saving scheme. Here, anybody who wants to save income tax will go and buy this. Maybe your parents at the moment, or maybe you might have bought these schemes. You get a 1,50,000 rupees exemption every year. Okay, if you invest this money into these schemes and invest 1,50,000, of course the exemption is under Section 80C, where you have to block your money for 3 years. That means if you have bought a ELSS scheme, your money is blocked for 3 years. You can't redeem the mutual funds. Now we call here redeem, not sell, because you go back to the mutual fund house and say that I want to sell. So he'll take care of this thing and give you money. So you don't go to the stock exchange and sell unless it's a closed-ended fund. We'll talk about that later. So it's called redemption. Okay, so you can't redeem your ELSS scheme within 3 years. This blocked for 3 years. Okay, and this exemption is also 1,50,000 includes exemption for provident fund. Your housing. I mean, if you're taking a house and you're paying an installment, or you're paying LIC premium. So 1,50,000 is a composite exemption. Okay. So if you're not putting any money in any other place like provident fund, you can put entire 1,50,000. Like I put 1,50,000 because I don't pay any provident fund or anything. So I can invest 1,50,000. But then there is another 50,000 exemption where you can even buy a pension scheme, which is called 80CC again. So you get 2 lakh rupees exemption per annum under 80C plus 80CC or D or whatever. 50,000. So overall it becomes a 2 lakh limit. So ELSS is only a fund. So please listen, because there will be a quiz. So you have to remember all these terms. Okay. ELSS, very important. So maybe it will be part of the quiz. Okay. So then there is a dividend yield fund. Here, some companies pay regular dividend. It is not mandatory for companies to pay dividend. Okay, fine. So companies can put their money back into the business and try. Not pay dividend. So some companies pay dividend. Okay, and if you invest into those companies, you get a regular income. Okay. So similarly, the fund out is going to choose those companies which are regularly declaring dividend. Okay, so you can opt for this dividend yield fund. Okay, now, for example, suppose the dividend yield of these companies is around 6 to 7%. For example, you are getting 6 to 7% by investing into some stocks or mutual funds which are buying these schemes. Then you get 6% kind of a return while you are invested into equity. So it's almost like you're getting your money on a fixed deposit where you're earning about 6 to 7%. Okay, so it gives you a feeling that you're getting 6 to 7% return per annum, and then you're invested into equity. But the companies which give dividend which give very heavy dividend and don't retain any profits of future growth, then those companies' shares value will also not grow so much. Fine, because they're not putting the money into business, and but business will not grow so much. Some companies don't even require a profit to be invested. For example, Hindustan Unilever, it doesn't have much higher requirement. It's a big company growing at a very good pace, but mostly it gives everything as dividend and retains a very less part for flowing back into the business. A Reliance, on the other hand, would like to put the money into their businesses instead of taking money on loan or this thing expanding their projects. So they give dividend, but they are not giving 100%. They just give some part of the profit as dividend, and most of the profit is retained, and you get a capital appreciation on Reliance. Similarly, a fund which is invested in Reliance, you will have a lot of capital appreciation. A fund which is invested into dividend yield shares, they will not have much of capital appreciation, isn't it? So that's only the drawback. Then we have the contra funds. The contra funds are basically whenever the fund manager believes that for example, what happened about 4 years back, all the pharma stocks were down. They were down by 50%. All the pharma stocks, they are subject to some kind of an inspection of their facilities by generally the FDA and other bodies, because they are supplying most of the medicine outside the world. So if there are a lot of objections and a lot of things are being raised by FDA, and if they don't clear it, they will not buy. So the exports will go down. So the pharma sector was mostly, I mean, having that problem about 4, 5 years back, and the stocks were down 50%. Now I got a call from the fund manager that we are taking a contrarian view that though the stocks are falling, but now the stocks will start rising very soon, but we don't know when, but they are going to go up. So if you want to put money, you can put. So that's a contrarian call. So he asked me to put, I put about 5 lakh rupees and it became 10 lakhs in a matter of 2 years. And the pharma stocks, though after certain decline for another 3, 4 months, so they buy the stocks which others are believing that they'll go down, but they sense is that it has already gone down so much that it will go down a further, but not a great deal, but then it start rising. So it's always better to, I mean, catch it early rather than catch after the appreciation happened about 30 to 40%, because when the stocks move, they quickly move, and you think that they have become very expensive. By the time you realize, and they become more expensive and expensive, so then you just drop the idea of buying those schemes or funds or those stocks. So they invest at the time when others feel just the opposite. So these are called contra funds. Okay. Then focused. Focus means that they're going to invest in, say, top 30, or not top, but 30 stocks, which they feel, or 35 stocks or 25 stocks, which they feel they are going to do well. Okay. And they remain with those, stocks. So they are focused towards certain industries, certain companies, not that they're just focused on a sector. They'll diversify against various industries, and they will invest into various stocks of various companies which are going to do well. Okay. So these are called focus stocks. Then we have value fund. Now, value fund means those stocks which are currently trading at a very low value, a low price earning ratio, low price to sales ratio, low EV to EBITDA multiple. These are all various multiples which I have not discussed, but I may discuss very soon. So these stocks are trading at a very low, multiples, and they have a great future, and people have not realized them because they have not been in the public, this thing, radar. So because these people, they go and interview with all those companies and find that they have got a lot of expansion plans. Infosys was a stock which was not valued so much. When it was listed yesterday, I was reading, when it was, IPO came, it was not fully subscribed. So Morgan Stanley or some company had, bailed them out. So now the company is doing so well. So at that time, somebody picked up Infosys. I mean, the IPO was not fully subscribed, so people thought that it's a small company, it may not grow. So they pick up companies at a very early stage. Okay, all the e-commerce industries, companies now. So they pick up those companies and they think that the future is good. So these are called value stocks, which are trading at a low multiple. Okay, whether it's a price to earning multiple, whether it's a price to sales multiple. I discuss about price to sales multiple? No. Like for example, so there are various the formula is market price divided by earning per share. Right? Now, P ratio can be high, low. If it is high, we mean that whether the stock is overvalued or stock is doing very well, people are buying it. It commands a higher multiple. That's why it deserves to be at that place. So it has two meanings. One, that it is overpriced. Okay, the company doesn't have a great future, so you should put that. Okay, it is already overpriced. The second would be that company higher, it has a higher growth. Let me just try to check it with the PEG ratio. Whether it is really, still cheap. For example, to complete the story, we just divide by the growth, the P ratio, and know whether stock is, okay. Or divide the growth, say next 3 years or 4 years or something like that. Or calculate the forward P ratio, 1 year forward, 2 year forward, to look at, whether the after 2 years how the ratio will look. Okay, so this is one of the very important ratios that all the financial analysts they look at. So SEBI has also incorporated that. When they give the explaining how they arrive at the value of a stock, they use the P ratio on the lower cap and upper cap, and also they compare the composite P ratio of the industry, and then find out whether the share is properly priced or not. So P ratio is, again, the P ratio has a lot of issues. For example, the earning per share. Now it can be subject to manipulation. An investing accountant, can declare a higher EPS. Now you report a higher profit by having certain accounting policies. So which means you will have a low PE ratio, isn't it? The same company, okay, think about two companies that are similar in nature. There is one aggressive accountant who is showing more profits. So the P ratio may look low, but the other company is doing the same thing, but there we have a very conservative accountant, so his EPS will not be that much. So that will look expensive. But now we have international financial accounting standards, so there is a very less chance now. People can make a lot of changes. A lot of accounting standards have been made. Even the leasing accounting standard has been now changed, which I'll discuss. How it was affecting the valuation of the company. So now again the earning per share. Here you are thinking about now one more thing. There is a numerator here and the denominator. Both should be consistent. Why? The numerator belongs to whom? The shareholders. Market price per share. And the EPS also belongs to the shareholders. So it is consistent. Okay? The ratio should be such that both should belong to the same category of investors. Okay? So P ratio is absolutely fits into this thing that it's a very a ratio which is now within the P ratio there are three variants which we discussed. So there is called a current P ratio, then the trailing P ratio, and then the forward P ratio. So whenever you're talking about the P ratio, you must ask the person that which ratio is talking about, the current P ratio, or the trailing P ratio, or the forward P ratio, because they're all different. Okay? Now, as far as the market price is concerned, it is the same for all the ratios. Only where the difference lies is the EPS. So if the EPS is, the last financial year EPS, then it becomes the current ratio. If it is the last trailing 12 months P ratio, last 12 months, then we say it's a trailing P ratio. For example, we are in the month of December now, okay, or November. So already 2 quarters performance have been reported from the market. So take the 2 quarters of this year and 2 quarters of the last financial year and add them up, we get the 12 months EPS. So if you are taking that EPS, then it becomes a trailing PE ratio. So that means we are current. The current EPS, if you are saying the trailing PE ratio is so much, then we are taking the last 12 months reported EPS. Okay. Fine. And the forward PE ratio would be looking 1 year down the line. Suppose we are expecting the EPS today is say 100 rupees and it will be 120. So instead of taking 100, you are taking 120 for calculating the PE ratio. It's called the forward PE ratio. Sometimes some analysts take 2-year forward. If they want to justify the valuation, they'll say the company is going to grow. Okay, let's take 2-year forward ratio and the company looks cheap. Fine. Just to put a point across that they want to say that company is cheaper and you should put your money. Okay, fine. But the 2 year is all the projections, isn't it? So it's not. It's a risky thing. You just rely on 2-year PE ratio. So is that okay? Any questions there? So in a trailing PE ratio, what we do? What is the difference?
The recent 12 months.
Recent 12 months earning per share is taken to compute the PE ratio. In a current PE ratio, the last 31st of March, like for example, all the companies close their accounts. So whatever EPS they have reported, if you calculate the PE ratio, then that is the current PE ratio. And if it is a forward PE ratio, then we look at the 1-year forward line, okay, or 2-year forward, depending on. So whenever PE ratios are being discussed, the first thing you should find out is what PE ratio the person who is talking to you is talking about. It's a current PE ratio or the forward PE ratio or the trailing PE ratio or 2 years forward down the line. Now, again, earning per share is basically, when you talk about, it's derived from the net income or the profit after tax, and the PAT belongs to the shareholders. Okay. Now, if there are two companies, one is having everything in equity. All the money has been financed through equity. They have not taken any loan. But there's another company which has taken a loan, isn't it? So they have some debt. So the P ratio will get affected. If how much debt component you have, your profit will get boost. You will have a low P ratio because you have a high debt and you're doing well. Okay, if you're doing well, you're paying, like 10% to your on your loans, but you're earning 20% of the total capital employed. The rest of the 10% is actually adding to the kitty of the equity shareholders. So if you have 100 crores capital, okay, think about one first case where all the money is being given by the equity shareholders. Fine, if they are earning 20%, they are getting 20% return on their return on capital, or return on equity and return on capital is the same. But if the company is having 50% equity and 50% debt, then it magnifies the return to the equity shareholders, because on a 50 crore rupees they are paying just 5 rupees, and the profit goes up. Fine, 15 rupees it becomes for the 50, so it becomes 30% return on the equity shareholders, isn't it? So you take 15 rupees the balance earning on the return on capital employed and divide by 50, you get 30% return on equity shareholders. So your return on shareholders magnifies in good times, but in bad times it can even magnify the losses if the company is not earning money. So the debt is basically good thing if you expect a good future, and the company is not cyclical in nature, and you feel that company will do well in times, then the stock is bound to do well, because it will show higher profits, and the people will buy it. Okay. Now, here the P ratio gets affected by the leverage. Okay. So this ratio cannot be relied upon all the time. Okay. So there were various ratios which came, which was the ratio which was being discussed was okay. Is it there?
Just at the corner of the board.
Corner of the board. Something called enterprise value. Enterprise value. Never? Okay. So it is basically the enterprise value is the market value of the shares, the market cap, plus the market value of debt. So the simple formula would be the market cap plus the market value of debt. Of your borrowings or loans or whatever. Fine. Simply add them up and minus the excess cash companies having. Okay. Just search for Google enterprise value. You'll find the definition in the Wikipedia and just fill it in the room. So the market cap plus market value of the borrowing minus the excess cash. What does it mean? Actually, it means roughly the value of the operating assets of the company. Okay. What are the assets which company buys? It comes from your debt as well as your own money, equity. You invest 50 crores from equity, 50 crores from taking a loan. So you have 100 crores and you invest into assets and start the business. So 100 crores is the book value of the assets, right? Because when you're taking the book values. But when you're taking the market value, when you're taking the market cap and the market value of the debt, you're saying they are roughly the operating assets of the company, the market value of the operating assets of the company. Why we minus cash, excess cash? Because the cash which is sitting in the books of account or which the company has, they're not utilizing it. Okay, they're being invested into various kinds of investments. They're not being used for the business purpose. Okay, so we are trying to find out what is the operating assets of the company. So that's why we reduce the excess cash. This is the word which is more commonly used in merger and acquisitions, where when your company is being acquired, you look at what is the enterprise value. Okay, so the word is being quite often being used in acquisitions and mergers which are taking place. So you'll find that the company's enterprise value is so much. So which would mean the market cap plus the market value of borrowings minus the excess cash. Okay. And of course, there is one more thing which I'd like to confuse you a little later, which is called the minority interest. Minus the minority interest. Just to give you some flavor about that. Suppose there is a company which owns about 80% of their company. So there are two companies, A Limited and B Limited. A owns B Limited. Okay, 80%. So that means B is a subsidiary of A Limited, isn't it? So as per law, they have to combine their accounts. They have to consolidate their accounts when they report. So they can report both standalone as well as the combined, consolidated. So you go to the screen and find the two views, consolidated as well as the standalone. Okay. Now, when they combine it, they combine all the assets and liabilities. But 20% of the shares they don't own. Okay. So on the liability side, they will put the value of 20%. That's called the minority interest. Okay. Just to match the balance sheet, because they have added, the assets of both the companies. Suppose the company A and company B, suppose it's having 100 crores here assets and 20 crores here. So they have actually written 120 crores. Fine. So these are the assets of the company. But out of these 20 crores, they don't own 20% of them. So that means 4 crores. So 4 crores will become the minority interest. Just simply to say that if they have only these all assets, so in liability they have the share capital as 100 plus 80% is 160. Combined share capital for both the companies plus the minority interest will be 4 and the assets will be 120. So the balance sheet will die to 120. Isn't it? Assets worth 120 consolidated and the share capital will be 116 crores or whatever, and then the minority interest will be shown as in the liability. So the company owns 120 crores worth of assets minus those 116. So we are writing the market value of all those assets will belong to the shareholders of the company and not the outside. So we are minusing the minority interest, but again this is done at the market value. So we take the listed price of the company which is listed. So we not at the face value, we are going to not the balance sheet value, which is reported in the balance sheet is the book value. So we are going to take the market value by looking at the price of the company's share at prevailing at that time and arrive at the market minority interest and calculate. Is that okay? Fine. So it's called the enterprise value. Now this is the total value of all the operating assets of the company. Okay. Now we all know there is a thing called EBITDA. So this is depreciation, amortization. If we take EBITDA divided by enterprise value, it's again consistent because EBIT means the profit belonging to all the stakeholders, whether they are equity shareholders, whether they are given money on loan to the company, so it includes EBIT. So EBIT upon EV upon EBITDA. So a new ratio which is there is EV upon EBITDA. EV upon EBIT. So there are various ratios of EV upon EBITDA. Fine. If you calculate ratios of all the companies and find out which company is the cheapest, okay, the lower the ratio, the company will be cheaper, isn't it? Then you have to find out whether the company has a good growth potential or not. If it is, then this is the best company to put your money in, isn't it? Yes. Fine. So, EV to EBITDA, all this is done. Then there is a ratio called price to sales. Now, because the EPS can be manipulated, so there is a case that instead of taking the bottom line, we take the top line and calculate the market cap divided by the sales figure. Market cap divided by, instead of I say price to sales, I can just rephrase it as market cap of the company and divide by sales. So we have another ratio. Okay. The company, suppose there is a company which is having 100 crores of market cap. Okay. And sales is 200 crores. But there is another company which has a market cap of 100 crores, but the sales is 400 crores. So price to sales of the ratio, the first ratio will be 2, other will be 4. Isn't it? So company which is having, let's put it here. Suppose the market cap of A and B. Suppose it's 100 crores. Both are having 100 crores. Okay? Whereas the sales of this company is 200 and this company is having 200. So the price to sales ratio will be 2 and this will be 4. Now if you have to put money, so it would be 0.5 and 0.25. 0.5 and 0.25. Oh, sir. 0.5 and 0.25. this company looks to be cheaper, isn't it? Because here the sales is 400 crores and the market cap is 100 crores. So if you have to think about which company is cheaper, they will say the company B is cheaper. This is the thing which I call B, which you have just pointed at the right time. So point two, so company B. So if you say that price is, the sales is 400 crores and market cap is 100 crores, then you say that this company is better, isn't it? Price to sales ratio. And again, the sales cannot be so easily manipulated. Fine. Now, the price to sales, again, the ratio is not very consistent because the price market cap is belonging to the shareholder and sales is out of the total assets of the company, which is being financed through both debt as well as equity. So the ratio is not very consistent, but this is being commonly being used. Okay, and some people thought that instead of taking market cap, we should take ED upon sales, so which will correct the ratio. Fine. But think about a sector which doesn't take any loan. Then the price to sales will be okay for them. So there is a sector which doesn't rely on, like FMC sector, which hardly has any kind of a debt. So price to sales, yeah. Yeah. So ITC or HLL or Colgate, so they hardly have anything, or IT companies. Okay, fine. Now price to sales is very good ratio for where, but some people say that we are ignoring the income. Now that is a very important part. We are not taking at all the bottom line into picture and costlier. So when you take one thing, the other problem will come. When you take the other income, then sales, affected by leverage and so many other things, because the EPS can be manipulated. So those companies which have a standard margin, for example, let's assume that there is an industry which has a margin of say 10 to 12%. Think about that, like Walmart or companies like that, which have a standard margin. Okay? So there are companies like that, Carrefour or something like that. All these companies, running malls market, so they have a margin of 10 to 12%. Their price to sales becomes very good because then the profit is same, so it is all distinguishes the price to sales, which is cheaper, which is costly, isn't it? Now you can just put, Google this thing, price to sales ratio, and say Damodar. Then you'll find, we'll go to the site, which is, done by valuation expert called Damodar, and you will have price to sales ratio of all the companies in the world, particularly the US companies, okay? So industry buys. Fine, you will have, price to sales ratio, EV to EBITDA ratio, price to earning ratio, all ratios you will find. It publishes on the 1st of January across the world, what are the ratios of all the companies. So if you have to choose and find, whether the Indian company is trading expensive, Indian companies are always trading expensive compared to the US market, okay? So, but you have an idea, when you are comparing the two companies, international companies, so you can have an idea, whether those companies are cheaper or costlier. Okay? And if you find that time, you can just, give a link to the Google. So I'm not going to that. So price to sales, okay, fine. So these are some of the common ratios. So in the last, in the junior classes, I have done an exercise where you have calculated all the ratios and then find out the company. So I'll just share the calculate with you also. Okay, so if time permits, we'll do. Is that okay? Now, so mostly we have all done. FlexiCap will again like a multi-cap, no change. So I don't know why they have given. ETF will be basically, I'll explain that later. Okay, so now you just go to large cap, for example. You go to large cap, and here is the download button. So download all this file on your Excel sheet. So there is an Excel sheet already which will be given to you. This will be made by this thing. So what we are doing, we are going to do, we are going to take all the 13 this thing and download the data. First, let's download the large cap. So we have got this out here. Now you can just, delete the first line. Sorry. Which is the header. Just delete that. You delete kyun nahi ho raha bhai? What I'm doing. Okay, delete. Okay. Then the plan. Now I'll just go back again. Just focus here. Fine. Okay, we'll go to that. Okay. It's a direct plan. I'll tell you what is direct plan. So delete this direct plan also. Delete this category name because all are large cap. So delete them at the moment. Okay, so we are left with this. Have you left with only this? Okay. 10-year, there is hardly anything you can even delete that 10-year. The column 10-year you can delete because there is nothing in 10-year. It's all blank. Maybe one scheme would be there. Okay. So have you got this? Yeah, again? Then just highlight this right up to the bottom where you have the data. Okay. Say Control T. So it'll say where the data is, where is the data on your table? Okay. It is there. So you'll find this. Okay. Then what you can do is you can make it like this if you want. I like this color, so I do it like this. And you can remain with the color which has given this thing. So you have got this?
Yes, sir.
Have you reached to this stage? Let me know. पहुंच गए? Now, just look at this. You can do it later. Just look at this and then I'll give you time to do that, okay? Now, this is, if you want to see, which company is having, now this is AUM, asset under management, okay? Now, this is, first is Chrysler rank. So this is the rank, you know what rank? So this is a 5-star rank. Suppose you want to invest only into all 5-star, all, 5-star. So you can just put zeros here so that, all this can be eliminated because these are not rated. And then, again press largest to the smallest. So you'll have, there are 3 funds which are 5-star rated by Chrysler. So these are, very good, funds which are 5-star rated. So we'll go into the rating later on. Okay. Then you have the asset under management. That means how much money has been invested in each scheme after it has grown, after the market has gone up over.
Investment fund or maybe the value of that NAV.
Just hold on. Largest to smallest. So, now, these are the top big companies. Yeah. What are you saying?
AUM is the market value of the
Market value, the asset under management, the total value invested.
right now, the current
Right now, it's not the NAV. Fine.
NAV
So,
multiplied by the number of units is equal to
अभी हम उसमें नहीं जा रहे हैं. So that means 36,871 crore has been into the scheme. So maybe this is a very popular scheme. Everybody is buying this. Okay. Then we have, the Access Blue Chip, ICICI Prudential. So these are the schemes in order of how much money today it has with all the public. Public का पैसा ये लगा हुआ है इतना सारा. Okay. Fine. So if you think that you are going to put money into only the large caps, where the money has gone into, maximum money has gone. So these are the things people are trusting. So you can choose, have that mind. Some people have that mind. But then the most important one which you do is that you're going to look at, 6 months. Last 6 months the market has done very well. Okay. 1 year time frame it has not done very well. So that's why I'm choosing 6 months. So you can choose 6 months and say largest to this thing. And then, you can put zeros here. And then, largest to smallest. So now, in the last 6 months, which is very important number, because the fact the market has moved in last 6 months, it touched all-time high, just few days back. So most of the funds have done well. Okay. Now, which is the top fund according to you? You have to select one fund based on the last 6 months at the moment. Which is the fund which is giving the maximum? Best Nippon, which you were saying, it was other Reliance. So I put almost like 50 lakh rupees in this fund, okay, which is giving a 19% return, okay, in a direct plan. Fine. We'll talk about direct plan also later on. So it is giving, still we will not get confused at the moment. So 19% return has been given, and which is the second best SDSE?
100.
Top 100. So one more thing you can do is that you can just highlight these percentages, okay, right at the bottom, and go to the 2 decimal places. Otherwise, for equity, even 1 decimal place is okay, or even the round number is okay. Fine. Now, because these 3 are very good, okay, as per 6 months, okay, so I'm going to just shade them up. I'm going to shade them up. The first, let's take first four. Okay, let's take first four. Okay, I'm just going to make them yellow. Fine. Now, I want to know how much they have done in the 1 year time frame. So I'm just going to do it large to smallest. So I'm going to put 0 because this I don't want. So I'll again do it. Now only two have remained. That means 1 year time frame, 6 month time frame, only two funds remain, which is in Nippon and HDFC. Rest have gone down. Now let's say 3 months time frame, okay? Largest to smallest. So I just put 0 here. I put 0 here. And so I'm just trying to identify which fund has done consistently well. 3 months, 6 months, 1 year. Then I can go to even 2 months, 1 year, okay, and say largest to smallest. So in 2 years time frame also, 1 year time frame also. Let's say 2 year, largest to smallest. Okay. So there are some extra funds which I'm going to put them because they were not there actually. That's why these two funds which are though in yellow, they were not available in the. So they'll go at the last actually in this case. So that means Nippon and HDFC in time frame of 1 year, 2 year, 6 months, they stood out. But there are two funds which are not there 2 years back, so it will be unfair. So let's put it at 1 year time frame to have a or year to date time frame, largest to smallest. That means this year April to till date. Again, the two funds remain. So 6 months. Let's go back to the 6 months. So we have the four funds. Okay. So first of all, we are trying to identify which are the funds which are doing well. Then we'll just do an X-ray of them. We'll go deeper into them. So based on the 6 months, these funds are your funds where you like to put money, or you can even go down to this also. Even you can choose top 10 funds also, or you can cut off that any fund which is given 15%. Okay, so we can do that exercise. Fine. Is that okay? Is this clear? Have you done this? Just first reach to this place, then we go. Okay. Sabka ho gaya? Have you done? Now Nippon India. Okay, we go to Nippon India. How much money is there? 12,534 crores, which has given 18.57% in the last 6 months. Now we go and see what Nippon Fund is, where they have invested the money, and we'll do some kind of an analysis in that. So Nippon India Fund is there right away here itself. So I'm just sorting here also on the 6 months basis. So Nippon. Okay, Nippon. So Nippon, I'm going to just go here. So I go to Nippon. Fine. Just listen to me now. Okay. Now look at this. The NAV is 61.4737 up to 4 decimals. That means each unit, if you buy today, it will cost you 61 rupees 47 paisa. Okay. It's a direct plan. That means you have bought it directly from the asset management company, not from the distributor. Okay. So if I choose regular one, okay, so no, it will be less. 56 rupees 36. That means rest of the money has been eaten away by way of commissions and to the distributor. Okay. If you had invested directly through the asset management company, it was worth 61, but otherwise it was 56. But anyway, we'll stick to that. So now what is learning? Learning is that if you want to invest money, you should go and invest in directly. Buy the funds directly from the asset management company. Go to the site of HDFC Mutual Fund or Nippon India and buy it there. Instead of going to a bank or going to a distributor and saying that give me forms, I want to fill up and I want to invest. So it will be having a stamp of that agent and that person is going to get almost like 1% every year from your kitty. Okay, almost like 1%. Now we'll look at the expense ratio here. Okay, look at the expense ratio. It is 1.1%. So 1% you have to pay. It's the money which the fund manager is charging you from you if it's a direct plan. But take a regular plan. So here the expense ratio goes to 1.77. So 0.77 money is being taken off from you. It goes to the agent. Let's go back to the direct again. So the learning is that as far as possible, we should invest directly and not from the distributor. But all my investment, 99% of my investments are through distributor. I don't buy them directly. Why so? Because I am not very comfortable. Because then, I have to go to at least 10 sites if I'm holding so many mutual funds to find out where my money is and, how much it has grown. And tomorrow if something happens to me, then my family will not be knowing where I have invested money. Otherwise, if they are computer savvy and I've given them all the details, so they will be able to search it down and find out where all my investments are there. Okay. So if you buy from a distributor, like for example, I buy from Kotak Mahindra, okay, or for some MBA company. So my wife and myself, we can just go to Kotak Bank and from the app itself and say, find out how much I have invested. All the investments are there. I can buy and sell them at ease, but I am paying around 0.5 to 0.6% more for that facility. But that's not worth it. Okay. But then what I'm doing is I've chosen a consultant who happens to be a Citibank person who was my relationship manager. He started his own company. Okay. He said they will not charge any money from the money which they get as commission from these fund houses. They're going to only pocket that, which is anyway going into that 0.5, 0.6%. But he's going to advise me also. Of course, with all this, you don't need any advice because everything is there with you. But sometimes it helps you. One day I got a call from my relationship manager who was handling my account. He said, I'm coming to your house because you need to immediately sell some mutual fund. Because there is some inside news that, that fund had actually, given a lot of money to ISL and they were about to default. Okay. And their rating would go from AAA to, say, single B or something, and the NAV is going to fall. So before the NAV fell, I had exited out from that fund, and it saved me about 1 lakh or 2 lakh rupees in that fund. Okay. So whatever you pay as a commission, you recover it by some kind of advice you get. Fine. Sometimes he told me that put in a pharma fund which they're going to do well, and it doubled my money. Okay. I may not be even thinking about that. And sometimes they will advise you so many things. Which will basically, you will always think it's better that the money is in one account, you can see them, and otherwise, if you have invested your money, now there's a problem if you invest through that directly. But every month, there will be a mail from the NSDL that these are your total money which has been invested. Wherever you have invested, so they will give you a consolidated list. Okay? Fine. If you are comfortable with that and your family is comfortable, it's fine. Remain with that, so you can just circulate that list to everyone that these are all what I'm holding. Okay, fine. But sometimes you don't keep a track of that also. So it's always better to put your money into a fund. But again, it is with the age. When you're young, always invest directly. Don't look for a fund manager. Now, is that clear? Now, some other things. It's a category large cap. Where it has invested? This is coming as large cap. Okay. Expense ratio. Category average is 1.05. So it is on an average against the category. So many funds are there in this category. Cheaper. So this is cheaper. 1.0% against the category average of 1.05. Then fund size. It is it's 5% of total category. If total money which is invested in India in large caps is about 20 times this amount, isn't it? If it is 5%, that means almost 20 times of this amount is actually invested in India in large caps. Okay. Then Crisil rank 5-star. Now 61.4747, there is a 0.18% increase. So that means last day it has gone up by 0.18% per day appreciation. Then riskometer, very high. Now, this is what the CRISIL or what the SEBI has now introduced, that all the funds have to mention in terms of risk-o-meter where they stand. It's in the dark red because all your money is into equity, and equity is considered to be riskier. And very good performance among peers. That is what the 5-star ratio tells you in nutshell. Just some more time. Then, there is an explanation. Just read, Padi, what's written here. The large cap fund.
The fund has 97.95% investment of which 73.27% is in large cap stocks, 10.26% is in mid cap stocks, and 1.41% in small cap stocks.
Okay, yeah.
Investors who are looking to invest money for at least 3 to 4 years and looking for high returns. At the same time, these investors should also be ready for possibility of moderate losses in their investments.
Okay. Now here it's a large cap. So almost like 70% and above is invested in large cap. Then the fund manager can invest rest of the money in any. So that's a SEBI rule that if you are investing 70% or more in large cap, it will be classified large cap. If it is 70% more in mid caps, it will be classified mid cap. You can invest your money. There's no this thing that they've invested almost like 10% mid cap and some small amount in small caps. Okay. Now you can see the return here. This scheme has given 15.99% return. How many time? 1 year time. And the benchmark, the Bombay Stock Exchange 100 stocks have given 10.2% return. Fine. So the difference between the two is called alpha. Okay, this is a very important term which is being used in investment fraternity. Alpha. The fund manager has generated an alpha about 5% or 6% over the benchmark. So you can even check at 6 months' time, it has still generated an alpha. Okay. Category average is 14, whereas this scheme has given 18. Okay. So in this category, if you look all the large cap schemes, they have given on an average 14. So this has given 18. So that's why it's having the first rank. Okay. Then, so there's a graph also where the blue one is for this scheme and the red is the benchmark. Okay. Just a couple of more things. Then, it has given, how much the money has grown per week, 2, 3 months, 6 months, absolute returns, category average, rank within the category. So 1 week it is second rank, 1 year, 6 months is the top rank, 1 year, 2 years. So it's giving the ranking also, in the various time zones and how much return it has given. Okay. So you can just have a look after the break. And if you have put a SIP, you can invest your money in systematic investment plan. That means 1,000 rupees per month, 2,000 rupees per month. Like this, if you put, your money, how much the money has grown. If you have started with a SIP of 1,000, in 1 year, it has given absolute return 13%, annual return is 25%. So like this, if you are investing, 1,000 for 5 years, so your money has grown to 95,000. So it has given 18% return per annum. Okay. Huh? Yeah. So tax treatment, very important here. Read this tax treatment.
Sold after 1 year from purchase date, long-term capital gain tax will be applicable. Current tax rate is 10% if your total term capital gain exceeds 1 lakh. Any cess or surcharge is not included. If sold before 1 year from purchase date, short-term capital gain tax will be applicable. Current tax rate is 15%. Any cess or surcharge is not included in the 15%.
Okay, just to understand, simplify. Okay,
It must have been if the starting of this.
In an equity market, in large cap equity funds, if you are investing, okay, so there are two kinds of gains: short-term capital gains and long-term capital gains under income tax. If you hold a fund for 1 year and sell it, it's called short-term capital gain. If you are making money on that, you are subject to pay 15% tax on that, along with a 4% cess. It's not 19; it is 15.4. Okay, and if you hold it for more than 1 year, then if you make some money, it's called long-term capital gain. You are subject to taxation of 10%, but a limit of 1 lakh. After that, only tax will be charged. If you had invested in 1 lakh, it become 2 lakh after 2 years, no tax. Beyond the second 1 lakh, you're going to pay a tax. So overall, it's a consolidated exemption limit. If you're holding 10 lakh rupees of mutual funds and you have sold them all and you have made a 5 lakh profit, on 4 lakh you're supposed to pay 10% tax plus 4% surcharge, 10.4%. So that is what it's saying. Is that okay?
Sir, if I've invested 1 lakh rupees this year, and after 5 years the fund is around 10 lakhs,
Yeah.
so 9 lakhs profit. So 1 lakh per year, or it's
नहीं, 1 lakh will be exempt. 9 lakh अच्छा दूसरा एक चीज होगा. Now you are subject to indexation benefit also. Every year the income tax department comes out with a inflation index. Suppose, for example, it is going by 5% per annum, and in example 50% is inflation. So if you have bought at 10 lakhs and sold at 16 lakhs, so 1 lakh to exemption will be, assuming 5 lakhs is your 50% appreciation, which is the inflation itself, so you don't have to pay any tax. So you get indexation benefit. That's in a very short, but you do exact calculation, the figure may come a little bit here and there. Suppose just saying that you bought it today, 10 lakhs, you hold it for say 5 years, it will give 15 lakhs. Okay, fine. Every year the inflation is going up by 5%. And that is, the index has been also going up from 100 to 105, 110, 100. So there's an index. I'll show you the index. So that means after 5 years it will be how much? 125. Okay. So 10 lakhs, 2 lakh 50,000 will be exempt because of the inflation. 1 lakh because of the basic exemption. So only 1 lakh 50,000 you have to pay 10% tax on that. Is that okay?
Sir, a quick question. This indexation calculation, do we have to do it ourselves for a CA, or
no, this is given. So you just say income tax index, capital gains income tax. Let's find out. Just find out, this thing. There is an index started in 2001. Huh? 331 now. It was 201 or 2001 it was 100, and today it's standing at 331. So something you purchased in 2001. So every year it is given. Okay. So you take the year in which you bought and the year when you sold. So numerator today's, denominator at the bottom when you bought, and calculate what is the appreciation. You will not be paying any tax. Right? So suppose today it is 331, and suppose 3 years back it was 300. So 331 divided by 300 into the amount you had invested. So that will tell you that how much appreciation will not be taxed. So that will do. Final calculations we can always learn later. Is that okay? Have you found this thing? Okay. So that's an index which you have to use for calculating, because this equity investment, if you hold for more than 3 years, okay. No, in this case it's more than 1 year. The indexation benefit is. But in case of debt instruments, more than 3 years. Okay. If you sell a house after 3 years, you are subject to long-term capital gains. But for equity market, it is after 1 year, long-term capital gains. Okay. Fine. Just 2 more minutes because it will be continuation, and we'll just complete this. So equity 97%, others 2.5. Okay. So there the money has been put by the scheme. Now these are the portfolio where your money has been invested. Of course, this is not the latest. This is 1 month old, because otherwise you can replicate and make your own money without investing now. So these people have actually researched. So they will not give you everything on a platter. Okay. So they are telling you the top 10 stocks of your portfolio. Okay. So सबसे ज़्यादा क्या है? Housing Development Finance, HDFC, which is getting merged with HDFC Bank. Okay. How much they are holding? Almost 7.5% of money is invested in there. Okay. Fine. And value is, this many million, and Larsen Tubro, Reliance, State Bank of India, ICICI Bank, HDFC Bank, ITC. So these are in order in terms of the top percentage holding. So if you put money into this scheme, so it will be invested in this percentage. Almost where 70 to 80% money is stay active, where they are invested. Okay. It always tells you that whether the money has highest lowest. So that means they are adding more during the year. They are adding 3.6, now they are adding 7.49. So that is, they are adding more and more HDFC. Okay. Similarly, if you look at say Reliance, for example, Reliance also will be going up. Yeah, Reliance has also gone up in terms of percentage of their holdings.
Sir, it also depends on how much this share appreciated relatively, that weighted average of 7.49%.
Absolutely. So then, after that, what you can do is you can just click this. These are all clickable. you can go to HDFC Development. Okay, this is last before the break. So it will take you to HDFC Corporation. Okay, fine. How much this stock has gone up, say, in 1 year? So you can have all the charts and everything, all the information is there. Okay. So I'll just, I'm just taking you to value research. There's another site, Nippon. So they give, a rating. They tell you the hold. That means they're not recommending to buy. This is a paid site, so you may not get so easily information with you. So 3 years it has given, this much of this thing. So then we can go to the portfolio also, as we had gone there. So it is telling sector-wise where your money has gone. Top holding HDFC. So they're telling you the graph also, at this thing. So look at this. HDFC, you can open this site, you will find some of the information is free. So HDFC Financial, P ratio is 20, percentage at 7.49, same thing. And look at the graph. So it is showing that it is going up. Okay. So it tells you the trajectory. For example, HDFC Bank is declining a bit. Okay. Then you can go to then it will take you to the HDFC Bank also. Okay. Here also you can see, 1 year, 1 day, how much it has given. 6 months, it has gone up by how much? 14 points. Though the Nippon has gone up by 17%, but it has gone by only 14%. Though it is the largest chunk of money is there. So as he said rightly, it all various percentages where they are invested. So they will calculate how much value on an average it has gone. The NAV is telling you because it is not everything money. All the money has not been put in HDFC only. It has put into spread into various assets. So it will reflect all the returns of various assets in their proportion of they are invested. Okay, fine. Any question? So we just have a break, and after the break, you will, you have already downloaded it. Okay, you are going to download all the 13 categories. Okay, spot the top 5, top 4, top 3, and then drill down to their portfolios, whatever analysis you want to do, you can do it. And as a project, if you want, you can also do this project. Find out which is the best mutual fund scheme, where you should put money. I mean, the large cap, mid cap, small caps, you can make a comparison, or you can do whatever analysis is just presented. Fine. So we can limit only to the equity. I will take you to the debt also later on. Okay. After the break, I'll just go to the debt, this thing, and then explain the debt also. And after the class is over, you can just spend time and do your analysis. Is that okay? So then we cover the theory part today. समझ आया? Was it interesting? Yes. Kasturja? समझ में आया?
Value.
There are many sites, but this site I have actually put all my investments and given me the full detail. Okay, break. 10:40. So up to 11 o'clock. So please do come on time. We are going to start a new series now, debt one. Okay, so it's very interesting, and it has a lot of learning. Okay, in the debt fund. So be there right at 11 o'clock. Maybe last half an hour you will do all the your worksheets. Okay, we'll go. I'm coming. I have to put